With hope rising that the pandemic's end could be in sight, economists predict a robust comeback for the U.S. economy. And just this week, the Fed chair said interest rates would remain low for the foreseeable future, which keeps costs down for anyone buying a car or a house, for example. But what about your retirement account or other investments? Earlier today, I spoke with Sandy Wiggins of ACG Wealth Management to get some insight.
Sandy, we've been talking about the economy and it's seemingly coming back. We sort of see the end of the tunnel there, the light telling us the pandemic is ending, vaccinations up, caseloads stabilizing. The Fed just the other day said it's basically going to hold interest rates down. What does that mean? Well, tell us about the economy and what all these signals are talking about.
Yeah, it's a great question. And really, if you think about what happened a year ago, the Federal Reserve lowered interest rates almost near zero in order to help create some stability as the pandemic began to unfold. And so interest rates have been low since that time. And having low interest rates is good for the economy. It stimulates purchases, and consumers obviously like cheap money. What the market is doing now is really looking at what does the next 6 months, next 12 months look like. And all ears were on the Fed yesterday to hear what they had to say about interest rates. And as you said, they plan on keeping them lower for longer. They're saying through the end of 2023. So that's good for the economy and generally good for the stock market.
So I'm going to be happy about my investments in that regard. But we've also talked about, people say as it heats up, so do the inflation concerns.
Yeah, there's a lot of talk about inflation right now, and there's even a lot of talk around the 10-year Treasury as a indicator of where the inflation markets are going or where inflation is going. And so if you think about inflation is really too few goods and services available to the demand. So as demand goes up, the price of things goes up because more and more people are chasing it. And if it gets too high, the price of airline tickets gets too high, people aren't going to fly, right? So there's a sweet spot that we're looking for. And there's some concern that inflation could get out of control later on this year as we all start traveling and getting back to normal life.
Well, and you have a graph showing us the 10-year T-bill, and then eventually vis-a-vis kind of what's happening in the NASDAQ, because I imagine a lot of people are saying, hey, my 401k did okay last year, but wow, I'm watching all these tech stocks, taking off the NASDAQ stocks. What kind of advice can you give us to understand that better?
Yeah, there's a lot of noise in the market, and the most important thing is right now, things are very, very good. A lot of opportunity in the market. We'll talk maybe a little more about that in a second. But if you want to look at one thing to try to get a feel for where inflation might be headed, look at the 10-year Treasury rate, and you can see this graph starts at the beginning of February. And it's a fairly steep and rapid increase in rates. And so as rates go up again, that could be an indicator of inflation getting hotter. And too hot of inflation actually can hurt the market.
And then you could show us, like vis-a-vis the NASDAQ, just in the last recent days, you kind of see sort of soaring, the NASDAQ soaring, and all of a sudden they kind of cross a little bit there. What does that mean?
Well, yeah, large cap companies like Facebook and Amazon, Netflix, Google, Microsoft, those are large tech companies. And the NASDAQ is an index that is a basket of those types of companies. And so we've seen a rotation in the market. As interest rates have increased, people are selling out of tech stocks and moving into other parts of the market. So again, it goes back to diversification. We've talked about that before. You don't want to have all your eggs in a large cap basket. You want to have them spread out other places so that when this type of environment occurs, you're not left holding, just large company stocks.
All right. Proof once again, diversification. Thank you, Sandy Wiggins, ACG Wealth Management, Midlothian. We appreciate it.
Have a great day, Bill.
And as always, talk with an advisor before you invest.